Thank you for joining us for VentureCrush by Lowenstein Sandler. This is Ed Zimmerman, and I'm the chair of the tech group at Lowenstein Sandler, where I've actually worked for over 28 years. And we've been doing this for 20 years, although we have not been doing this by Zoom for 20 years. We have a couple of announcements, and then we have a special treat for the first 10 minutes or so. We'll go until about 1:45, and we'll work in some of your questions. So at our last VentureCrush, we were really pleased to announce that Meredith Bushaw, who is a tech M&A partner at our firm now, had just joined us from Cooley. And we had worked opposite her in deals and had also shared clients, which we really didn't want to be sharing with her. And so we had gotten to know her and are really excited that she's come aboard. And we announced last week that Rossi Turman, who was a partner at Skadden, a couple of blocks away from our Midtown office, joined us after 21 years at Skadden. And he will be leading our practice on tech in Africa and also our practice in international finance. Rossi understands debt deeply and has also worked for decades in Africa, and I've been doing stuff there as well. So in fact, the first morning he joined us, we gave a presentation to about 36 lawyers in Africa. So it was really, really exciting. We're also going to mention that we have our next VentureCrush coming on November 12th, and we are really excited because that's going to be a conversation with the founders of Imagination Capital, Rachel Lamb, who ran the venture arm of Time Warner, which was Time Warner Investments, and she was there for 15 years. And she has partnered in Imagination Capital with her mentor of many years, Dick Parsons, who was the chairman of Citigroup, the chairman and CEO of Time Warner, and the interim CEO of the LA Clippers, among many, many other things. And I have been asking Rachel for years if we could get Dick Parsons to come speak. So we're really excited about that. And our own Diane Moss, who works in our tech group here at Lowenstein Sandler. But Diane, for many years, worked under Dick Parsons at Time Warner, and also Dick had helped her get involved in the Quincy Jones Listen Up Foundation as well. So the four of us will have that conversation on Thursday, November 12th from noon to 2 p.m. And we hope that you will join us for that. The final announcement that I'm supposed to make is we have our applications for VentureCrush FG pods. We'll drop a link in the chat for that. And you can click through the chat for more details on how that virtual program will work. And we expect that at some point in October, we'll be making that announcement. And you now see that Regina Gwynn has joined us. Regina is a friend and is the co-founder of Talk Tech Association and Black Women Talk Tech. And we are super excited because Black Women Talk Tech has released about 7 minutes ago really important research and a report that they've been working on for quite some time. I'd actually like to say that we've been working on only because in June of last year, June 2019, I joined the board of Black Women Talk Tech and love the organization. So Regina, do you want to tell us a bit about the report and maybe even share a screen? And thank you for being at VentureCrush.
Absolutely. Thank you so much, Ed. I'll go ahead and share my screen. All right. Can everyone see? Can everyone see the screen that I have here?
I sure can.
Okay. So again, Ed, thank you so much for allowing us to share some VentureCrush time. We definitely are excited to share the results of our first research report entitled "The New Face of a Founder, Uncovering Black Women as the Next Billion-Dollar Founders." the researchers on this report surveyed 671 self-identifying Black women tech founders to learn more about their businesses. So this is the largest report that's been published around Black women tech founders and understanding the challenges that they face. So, Black women tech founders are highly concentrated in high growth industries, such as education, finance, health tech, emerging industries such as AI and machine learning. And so these women we've discovered that Black women have been achieving hockey stick growth and have a built-in advantage with customer loyalty. So we want to talk a little bit more about the program, and let me just come here and share a couple of other points. So the data and the stories Black women tech founders surveyed inform actionable recommendations to help anyone in the tech ecosystem, whether you're an investor, whether you're a policymaker, whether you're a thought leader, a journalist, founders, and others. We want everyone to learn more about the work Black women do, the funding they don't get, and how to overcome the tech sector's poor diversity record and unlock billion-dollar opportunities. We also want to definitely thank Samsung Next, the CERNOVA Foundation, and the New York State Energy and Research Development Association for helping commission this research. So super excited to share some fast facts. So 37% of Black women tech founders are building startups in some of the fastest growing tech industries that account for $5 trillion in global market value. So the top 3 markets are fintech, education tech, and healthcare tech. So these founders are really driving innovation here, and they should definitely get another look in terms of investment opportunity. But yet 91% of those surveyed have other jobs, given the lack of funding to support themselves solely through their own ventures. And this just really reinforces this idea that this idea of a friends and family round. Oftentimes you hear of founders being able to raise $500,000 or $200,000 from their friends and families to essentially support themselves to focus full-time on their businesses. And yet 91% of Black women tech founders are unable to do that because of that, they end up having to get other jobs. But you'll also see that 52% of our founders report that they're providing more than 20% of their personal income to their business. So when we get questions around investor, the types of information that investors are asking us on passion and commitment, there's different ways for those kinds of questions to be answered. 60% of Black women tech founders are likely to purchase goods and services from other Black-owned businesses, but cite lack of availability and access as a major barrier. So here's an opportunity that continues to grow, and we're seeing this across the country in terms of a commitment to supporting businesses of color, entrepreneurs of color, but lack of resources in terms of amplification and visibility. So these are things that we find are huge opportunities. 63% of respondents saw increased traction in their business in the 6 months prior to the survey date, and 40% of survey respondents note that they have paying customers in their business, all without getting the seed funding typically used to get that initial traction. So Black women, again, these are founders that are creating businesses without the resources and without the traditional capital that's afforded to some of our mainstream counterparts. And 70%, I think this one also is actually super important, 70% of Black women tech founders are solo founders. They may themselves be a technical founder or not. So when we think about founding team and what that looks like and how that potentially reads to an investor, we have to rethink what that profile of a tech founder truly looks like. So what does all this mean? This is some of the very initial reads of the report. I'll include the link to the report on the next slide, so you guys can definitely learn more about that. But ultimately, Black women are the fastest growing segment of entrepreneurs in the country and building businesses in growing global markets. they're tapping into profitable sectors, as I already mentioned, and they're gaining traction across many of the key performance indicators that the tech industry values. So again, if you think about the information that VCs typically gather from tech founders, it's how strong is the management team? What is the market opportunity? Has the founder raised significant funds already? Has the business experienced early traction? Does the founder have a passion for her business? So we're seeing that there is passion here, there is traction here, there is market fit, and there is a strong management team. Black women have 46% of survey respondents have a professional degree, including master's degrees, doctorates, JDs, PhDs. So, when we talk about what the challenges are, Black women can't answer these questions because they're not being asked. And so we want to really rethink that pipeline and rethink what access looks like across the tech ecosystem. So how you can help. That's the main reason why I am here, is to promote and launch our research report. It just became live this morning. Please visit www.talktechassociation.org/research-report. This will allow us to get the report into as many hands as possible, as well as get to learn and educate for yourselves. We also encourage developing a diverse referral network. Definitely coming to experiences like VentureCrush. Ed does an amazing job in committing to diversity and expanding the pipeline of tech founders of color. Invest in Black women founders. The biggest way to support and to help is to cut a Black woman founder a check. These are the ways to really be able to move the needle in terms of scaling her businesses, because we're only scratching the surface. If she's already doing creating this amazing amount of traction and growth without resources, imagine what that investment could look like for your bottom line. Next is to educate your peers. Share that report with other folks in your ecosystem and within your community. And then lastly, supporting organizations that help Black women. Black Women Talk Tech is a collective of Black women tech entrepreneurs that was established in 2017. We will have our conference coming up in 2020, well, next year, second half of 2021. But more importantly, we're actually in the process of doing more investor matchmaking. We've had funds approach us on how they can connect more deeply with our founder community. And our founder database is actually coded against 38 points of data that allows us to curate this network and serve up founders that could be the best fit for their fund. So we're more than happy to have conversations around building out some investor matchmaking, an investor matchmaking initiative for your organization. But more importantly, the first step is just to become aware, see these data-driven analysis that was generated by the largest report or largest survey of Black women founders to date. And that is all that I have for today. I know that I don't have a lot of time, so I thank you so very much for the opportunity.
Before you escape, first, thank you. That was terrific. And I love that you're not only sharing this data, but that you're also giving us action items that we can act on immediately. And while I think a lot of people know the data that Black women are disproportionately underfunded by venture historically, and that valuations are lower and that the average amount raised is much lower, having an understanding of things like 91% of surveyed Black women tech founders have other jobs changes the way you think about saying to a founder, we need to see commitment and skin in the game. We need to see that you've quit your day job. No, you don't, actually. And so I know that data point, was useful for me to share with my class in venture capital in the MBA program at Columbia a week ago, because it was relevant in the case. In the case study, you've got people saying like, you've got to show us commitment and quit your day job. No, you don't. And I think that there are empowering pieces of data in here, and I thank you for sharing that. And you yourself are also a tech company founder. You're the CEO and co-founder of a company that we're very proud went through our VentureCrush FG program. Do you want to give us a 30-second hit on that? And then we'll let you carry on.
Absolutely. So I am also the CEO, as Ed mentioned, of Trust Noir. Trust Noir takes the guesswork out of finding the right products and services for women with textured hair by matching their unique profile to a beauty regimen designed by experts. So we use machine learning and artificial intelligence to map our cosmetology recommendations for women across the country with any hair texture and any hair type at any time.
Awesome. And a little later in the event, if you're able to share a tweet and a link in the chat to everyone, that would be great. Thank you so much for being here, for doing this important work, and for sharing launch day with our VentureCrush community. And we'll be sending this to the folks at VentureCrush as well, or on the VentureCrush list. So thank you.
Thank you so much, Ed. Really appreciate it.
All right. Okay, so from Black Women Talk Tech and the new face of a founder, I would actually like to go to the next most logical place, which is the Russian forests where we can forage for mushrooms. So I don't know if any particular panelist has anything they want to share about foraging for Russian forest mushrooms. Anyone?
I do. Wait, let me show you something.
So, Julia, your beat at the Wall Street Journal is venture capital and
Very
fungus,
exciting.
correct?
Yes, yes, that's my beat. See, I'm very excited about the story today.
So I thoroughly enjoyed reading about hunting for mushrooms, which I myself have done, but the story has special resonance to you, which you did not discuss in ink on the pages of the Wall Street Journal. Do you want to talk a little bit about that and the story?
Sure, I'll just mention that I grew up in St. Petersburg and used to go mushroom hunting with my grandparents. So when I found out that this year there's a march of the mushrooms in the forests in St. Petersburg, surrounding St. Petersburg, I thought it would be a fun story to cover and let people imagine what it's like to be bitten by flies and yet be ecstatic at the same time about your full baskets of king bullets. So if you're interested in what it's like, take a look at the story today.
It is a great story, and I believe that they were in particular horseflies, not just which I assume are bigger. I'm from Brooklyn.
Deer flies, I think.
Deer flies.
Yeah,
Oh,
it's a
yeah.
special, extremely annoying type.
Okay, and so after a childhood full of mushroom hunting, you ended up at Edward R. Murrow.
High school, yes, in Brooklyn. And I didn't do any journalism there, though.
Named after an incredibly famous journalist who, for instance, might be an effective moderator of things. But Murrow was not a place where you were inspired to become a journalist?
No, it really occurred to me only in college, but it was an amazing school with an amazing principal who passed away about 10 years ago. But I feel incredibly lucky that that's the school I went to.
Okay, and
very liberal, kind of like in terms of letting kids like kind of skip class if they wanted to, and pick any type of class that they wanted. AP, if you didn't even have the grades, you could go to take an AP class, for example, and things like that. So then I went to Brown, which kind of reminded me of Morrow High School.
And so because I went to a rival high school, Midwood in Brooklyn, go Hornets, although I was not I guess I was on a team.
Morrow had no sports teams.
Yeah.
So there was another weird thing about it.
And I was not a competitive athlete in high school, or really ever. But my sister went to Edward R. Murrow, actually, as we talked about some time ago. But how did you end up covering venture capital and tech companies at the Wall Street Journal?
Um, I guess I kind of just fell into it originally, but I love it. It's a great beat. You meet a lot of smart people, very enthusiastic people who try to change the world. It sometimes works, sometimes not the way they expected. So it's always something new. So I've been covering this beat for quite a while.
Okay. All right. Well, we will we'll come back, and Keith, you are on the board of a nonprofit in New York. Am I right about that?
You are correct. I am a board member of the Oliver Scholars Program, which is a program that's been around for close to 35 years now, primarily focused on taking minority students, Black and Latino students, out of the public New York City school system, providing them with appropriate training, and then ultimately placing those students into independent high schools. So it's a program that's done fantastic work. The stats and the really speak for themselves in terms of the graduation rate from high school, the enrollments into college. It's roughly 99+% of the students who have gone through the program have gone on to be not just high school grads, but actually college graduates. So the numbers are astounding. Roughly a third of the students end up at Ivy League institutions. And so it's a program that's near and dear to my heart personally, primarily because I was an alum of the program way back when it was first getting started. So I'm a native New Yorker, and an awful lot of my initial experiences in high school were shaped by going through the Oliver Scholars Program. So always glad to give back a little bit.
Terrific. And I know that you at some point went to the best Ivy League university that starts with the letter P. And you have been in banking for quite a while and switched banks a few years back. Can you talk a little bit about where you have been and where you now are and what you do there?
Sure. So Ed is referring to the University of Pennsylvania. Go Quakers. I also went to Brooklyn Friends High School, which was also Go Quakers. So just kind of got dragged into the Quaker mystique for high school and college.
The Quakers, by the way, are not known for recruiting hard. I mean, there's no big like proselytizing Quaker organ, just so that we're clear.
Not at all, and I'm in no way a Quaker. But coming out of college, actually, my first job was actually not in banking, but was at Sports Illustrated magazine, where I chose between being a 22-year-old, being very interested in sports, or going to work at an investment bank in the financial institutions group. And I chose with my heart, not my wallet, and ended up at Sports Illustrated. But a few years later, after business school, started working at Lehman Brothers in their private placement group, spent a number of years there, and was still at the organization when Lehman went bankrupt during the financial crisis in 2008. I ended up staying with Barclays as part of that organization, and ended up running the private capital markets group there for a few years before transitioning to JP Morgan, where I started our private capital markets group and currently serve as the global head of that group, which is primarily focused on working with, we do a number of things, but the one that's most relevant for this conversation is really working with companies, most of them venture backed, in the 1 to 4 years before they start to think about an IPO. So we've raised capital for companies like Peloton, almost $1 billion over the 2 or 3 year period before they went public. Companies like LegalZoom or Rent the Runway. We just announced a transaction last week for Zwift, for those of you who are indoor cyclists and avid fitness enthusiasts. We've raised capital for companies like Sweetgreen Salad if you are into healthy eating, and for companies like Mod Pizza if your eating tastes run a little bit less healthy. So we tend to spend quite a bit of our time with founders and the venture community, getting to know their companies, getting to know their visions, and then ultimately as they think about transitioning into public life, trying to get the right set of shareholders and the right amount of capital into those businesses to help them thrive as they take that next step.
And did your engagement letter with Mod Pizza include a prohibition against calling their food unhealthy in front of hundreds of people?
Not not unhealthy, but when you compare it to Sweet Greens, a little bit different. My taste actually went a little bit
Okay.
more to Mod Pizza than Sweet Greens, but I love them both.
Okay. Fair enough. And I know that one of the things that we're going to want to talk to you about is secondaries. And we did a survey of the people who registered for this event. And a bunch of them do want to talk about secondaries because it turns out that people like to sell their stock at some point. So we will come back and discuss that. I wanted to move to, I guess, San Diego and stoves in Africa to talk to Lauren about her background a little bit. Those two things seem relevant to your background.
Okay. Yeah, I grew up in San Diego, and then like YULIYA, went to Brown for undergrad. And YULIYA, this will sound very Brunonian to you, but I, while in school, started a nonprofit organization with a number of my classmates to bring solar cookers and biogas digesters to East Africa. So I've always had an interest in technology as a driver for economic development. And I would say even more recently, spent a lot of time thinking about technology as a driver for financial inclusion.
And right out of college, you went right into high finance.
I know. I went to the Clinton Foundation and worked on technology partnerships for them, especially clean technology partnerships based in Delhi for some time. And then the recession hit, and I went and decided that I was going to get a real job, and went and worked at Google, finagled my way into a product marketing role on the Google Apps team before it became G Suite. So early days of consumerization of enterprise, led the Google Drive launch and a bunch of others. And then went to business school. And as I was gearing up to graduate, my longtime friend and mentor, Teresa Gao, told me she was going to be leaving Excel to start her own firm, Aspect Ventures. So I joined her there, and became a partner leading fintech investing for us. And then Teresa and I recently spun out and sort of relaunched as Acrew Capital, with a number of our Aspect colleagues. So we do Series A, seed, Series A, and Series B investing across various categories of tech. But I spend most of my time on fintech.
And Julia actually wrote about the departure from Aspect and the formation of Acrew. And something I have not shared with the two of you is that the day that story came out, or maybe it was the day after that story came out, I was teaching my venture capital class at Columbia, and I was teaching the Aspect Ventures case. And I had been talking to folks at Aspect, so I was aware of what was happening. But when I was asked, you know, what happened, and students had seen the article, it led for a really interesting class discussion, and I disappointed my students by having no comment. So thank you very much for adversely impacting that class for us, Julia. Appreciate that. Oh, you won. And you at Aspect and at Acrew, you actually have a thesis around, you're doing stuff in health tech, you're doing stuff in fintech. You've got companies in San Francisco, you've got companies in Atlanta, you've got a cybersecurity company. I'm going to ask for a little bit of a synthesis of what it is that you're doing. But when Regina talked about most of the Black women founders that they had surveyed for the BWTT research report that just came out, she said fintech, health tech, ed tech, and I felt like all of those things are kind of covered in Acrew's thesis. And I'm just wondering whether you're spending more time on fintech, you personally, on fintech as opposed to health tech, and does Chime kind of skew that for you?
Yeah, so I spend a lot of time on fintech and some SaaS, but there are a lot of industries that now overlap with fintech. In fact, you know, I think a lot of industries are finding that fintech is a way to monetize. And so companies that were not traditionally considered fintech companies are becoming that. And so that's why my investments do kind of span a number of different things, but fintech is certainly kind of at the core of many of them. But with Chime, that was an investment that I led back in 2016. It was sort of early days of the last wave of fintech, as I'd call it. Where you see a lot of existing financial products coming online, serving a wider audience, and becoming more accessible with a really great digital face. And Chime really took advantage of that, especially coming out of the last recession. I think a lot of millennials being digital first and being kind of scarred by traditional finance institutions were looking for an alternative solution. And, you know, we saw that early, and we're really impressed by Chris and Ryan and the team. And so that investment has been a really exciting one for us, obviously. And I think a really good example of how tech can drive financial inclusion, because most of its members are people that are living paycheck to paycheck and find a lot of value in the transparency and the services that Chime offers that are particularly geared for them. Yes, that is one example of the types of companies that I invest in.
Great. Well, we're going to talk a bit about the Chime story a little later, and we're also going to talk about emerging managers raising funds, because that factors into the Chime story. And I've dropped a Twitter thread that's short on that. Not that I want to take anyone away from this conversation, because we're going to move over to Bates and Garth. Garth, you've got some connection to Bates and have been involved there for a while. You want to, I see that you're smiling, which is good. You want to talk a little bit about that? I see that you're frozen as well, but other people are not.
I heard Bates, Ed, and then I did not hear anything else.
Yes. So I know that you are involved in Bates, and I thought that maybe we could start there and get a little bit of your background. So if you want to talk about your involvement at Bates.
Sure. So went there for undergrad. I'm now serving my second term as a trustee, and as you can imagine, helping a school manage through a pandemic, not only the quick and sudden shutdown last year and figuring out how to get students home, also just the reopening this year. And so we've actually successfully reopened and have students back on campus. And so far we've been able to keep the COVID cases at a minimum. And so we're pleased about that. And since we're talking about Ivy League schools, I did go to Cornell for business school, so I want to make a plug for Big Red.
Okay, and we do, have a heavy dose of New York folks on this Zoom, and so I know that people in New York in particular are very fond of Cornell. And top tier, there's a real range in terms of the activity that you engage, and I see people now commenting to the panelists, go Big Red. There's a range of activity, right? You folks do a lot of secondary, meaning that you're buying shares from shareholders rather than from the companies themselves. You also invest in venture funds, and you also do direct investing, and you're kind of involved in all three. So maybe you can talk a little bit about that and about your specific fund at Top Tier and how that works in the Top Tier family.
Yeah. So I've been at Top Tier for about 11 years. Moved out here really to focus my career on venture. At Top Tier, we're a global firm. We've got offices in Boston and San Francisco, as well as London. One side of the house, as I like to describe, focuses on fund investing. So investing in both kind of more mature funds, higher Roman numeral funds, but also we will look at smaller and up and coming funds. I spend a little bit of time over there, but the majority of my time is overseeing our direct investment activity, as you described, both in buying secondary shares from founders or former employees, but we also will purchase secondary positions of funds, so older funds that are in year kind of 10 and beyond that still have some interesting assets available, and then we'll purchase those. And then we also invest directly in companies. So we're kind of late B, early C, kind of more growth capital, basically where we're cherry picking the opportunities of our fund of funds portfolios kind of on the other side of the house. And so we write a check anywhere from $5 to $25 million, fill out rounds, lead rounds. And that's been a growing activity for our business at this point.
And you are an East Coaster originally, right? And we lost you to the West Coast?
Correct.
Is that what happened?
Grew up in Baltimore, diehard Ravens. Yes, yeah. Well, when you go to Bates undergrad in Cornell for Business School, I've seen enough snow to last me a lifetime. So I can deal with a little bit of smoke and a little bit of fog. Okay.
And we hope that everyone who is dealing with smoke is doing okay. We know it's pretty horrendous out there. So thank you, and sorry that we couldn't retain you on the East Coast, but glad you're at top tier. All right, so let's talk a little bit about some of the issues that people wanted to hear about. And thank you so much to all of you who completed the survey. Really appreciate it and take seriously the time that you put into it. So we will be asking some of the survey questions, and we do have the math back on what you wanted to hear about. And there was tight clustering at the top. So by a very narrow margin, what you wanted to hear about first or most was, we've overvalued public and private companies in such a way that we are bound to have dampened outcomes. How do I time the markets for exits and fundraising? And since we have people with real expertise on achieving partial liquidity, which is not to say that you aren't experts at achieving full liquidity, private companies, are we overvaluing these companies? It's for any one of you who wants to jump in. Just know that whatever you say, Julia is going to write about it tomorrow. No pressure.
I'm happy to start. And the way I think about valuation is, it's a mix of, the fundamentals, and it's a mix of the market conditions. And, from time to time, we do see periods within the market where the IPO markets are incredibly robust. That tends to filter down into the private markets as people start to think a little bit about how do they exit the business into the public markets. And I think in today's environment, we're in a particularly interesting time in which a number of the fundamentals, may be somewhat divorced from the market, realities. And so we have very exuberant public markets as it relates to IPO performances. If you took a look at, the average IPO this year, it's up meaningfully. So as an asset class, it's worked incredibly well. And so private companies that are in a position to go public are absolutely starting to think through, will the public markets be there for me? I'm also a big believer that you don't necessarily want your financing strategy tied to, you don't want that to lead your business strategy. It really should be the business should come first, and the financing strategy should follow to support the overall business strategy. So we don't like to think about timing the markets. If it's a full exit, that's one thing. But if it is a partial financing from a fundraise or a partial financing from an IPO, you really still need to run your business for the long term. So we try to encourage our clientele to not necessarily, use the markets and try to think about timing the markets for any particular partial exit, because if you go public, you still need to be a public company for a long time, and you're not really cashing out fully. So we try to be thoughtful around it. So I wouldn't say the markets are necessarily overvalued right now from a private context standpoint, but I do think it's important for people to think about, how do I run my business? How do I build my business for the long term? And then, the financing will naturally fall out. And I've done this for a long time. And so in good markets and in bad markets, high quality companies always get financed. And that's really how we try to advise our clients.
Okay, Garth, you're shaking your head in agreement. Do you want to endorse every word that Keith just said?
Pretty much. I want to also support his pizza over salad statement as well. But I think that Keith's last point is a really important one, that high quality companies will be able to raise capital and go public. The only thing I think I would add to that is, as you're thinking about kind of valuation in a kind of heated market that we're in, I always encourage founders and CEOs just to be mindful of balancing that high valuation with where the company is in its life cycle. I have personal experience of seeing companies kind of overvalue themselves too soon, and actually puts a lot of pressure on the business to actually kind of grow into that valuation. Or if you're going to raise a subsequent round of financing and you haven't kind of hit the milestones that you had hoped because something unforeseen like a pandemic hits, you put yourself kind of in the corner unintentionally. So just be mindful of where that valuation comes out, and that it's not, you should never maximize for the highest valuation, because it often kind of comes back to bite, hurt you in the long run.
Yeah. Lauren, I don't know if you want to weigh in. I've got another question on this particular topic, but if you do want to weigh in, go for it.
I mean, I guess I would answer it a little bit differently and say that, I mean, if you look at what's happening in the markets, tech is clearly winning, right? And as a result, there is a halo around the industry, I think, in general. And so that means inevitably some companies are going to be overvalued. But the reason technology is winning is because I think there are a lot of tailwinds right now that really drive business fundamentals working in a lot of these companies. We're all being forced to live our lives online. And so I think that when I look at the fundamentals of a lot of businesses in the industries that I cover, and fintech and in SaaS, for example, many of them are doing exceptionally well. They're on a tear right now. And so I think there's reason for what we're seeing, even though, as I said, I think that there's a bit of a halo as a result, and some companies benefit from that maybe don't have the fundamentals.
Yeah, and I want to talk a little bit about businesses that are on a tear, businesses that aren't on a tear, and the opacity of private capital. So Julia wrote this great piece in July about how venture funds and their investors differ on portfolio valuations during the pandemic. And in the article, Julia talked about Fidelity Investments having marked down its stake in Bird, the scooter company. And they had marked it down to 34% below the price at which those shares were purchased 2 years earlier. Meanwhile, Tusk Venture Partners did not change the estimated value of Bird shares in Q1 of 2020, despite the fact that we were on lockdown. I don't think that Bird, and I have nothing against Bird, and I hope that it does well, and I hope that we're all out of this pandemic and the quarantine. But I do think that it's really interesting, and as an LP in a bunch of venture funds myself, I do see different funds treating their positions in these companies very differently relative to market, and it's very hard to make sense of that, and it is invisible to most of the outside world. So when we talk about, strong fundamentals and things being overvalued, are you more like Fidelity, marking it down to 2/3 of what you paid for it 2 years ago? Or are you more like Tusk, riding the high valuation that was just pre-pandemic when it comes to some of these companies? And how do we figure out whether the market is in fact completely overvalued as a result? And Julia, you're welcome to try and figure out what the question I buried in there was. But you know, it's really difficult to figure out what's going on in these markets because you're allowed to not mark stuff down. So what was the reaction to that article? How do you think about funds touting their investments and other funds marking down the very same investments on the same info?
I mean, when did that come out? That came out in June or something like that, or
July 20th.
early July. Yeah, from what I heard after that from LPs was, you know, they didn't really see many markdowns in Q2 once that kind of all got accounted for in venture portfolios. So my impression is that most VCs are remaining optimistic, and you know, just you know, and many LPs, from what I understand, they kind of do their own estimates. They take the VC portfolio marks, and they don't necessarily buy it at face value, right? Because these are private deals and private companies, unless there was a deal that happened in Q2 that marked the preferred shares at a different value. It's kind of guesswork. So they just kind of,
yeah.
You could say get away with it, or you could say that LPs aren't, you know, don't necessarily buy it at that face value.
You can also, I think, take the view that, you know, valuations are a point in time. And so if a venture fund is not necessarily looking to, you know, monetize at a particular point in time, and they have a view that, you know, the markets will recover, you know, consumers will go back into the office, you know, they'll start using the product or service again, that maybe there really is no specific catalyst to make a mark at any one point in time. The mutual funds don't have that luxury. You know, they are marking independently every quarter. And, you know, one of the little known facts about the mutual funds are that the portfolio manager who makes the investment actually has no say whatsoever in how that investment is marked on an ongoing basis. And so they tend to look at things on a longer term horizon and where the ultimate investment will shake out. But the portfolio manager really has no say whatsoever in the ongoing quarterly marks, which is a little different from a traditional venture fund.
And Garth, are you seeing, you know, because you sit in top tier looking at LP investments, and if participants want to add into the chat, I'd love to hear what you're seeing, doing, or wondering about how these companies are being marked up and whether there is a divergence of valuations. But what are you seeing from top tier about how investors are marking these up or down?
Yeah. So your question specifically how the company is doing, I think, is a really hard one to determine based on these valuations. Even pre-pandemic, we do a lot of work when we're evaluating a fund on how the manager is valuing the companies, and we see through our database a vast dispersion of values for a particular company. And we always kind of scratch our head how one GP could be valuing a company, you know, as much as 4 times higher than another GP. It all depends on their policy. We've even seen this discrepancy using the same auditor. And so it's really hard to get a sense of how the company is doing. To add a little levity to the conversation, you'd be surprised or not surprised that typically valuations tend to go up a quarter or two prior to fundraising, and they have a remarkable ability to reset after the fund has been raised. I've only seen that for almost 2 decades, and so don't have specific math on it, but it is a very consistent trend where evaluations tend to get a little bit more aggressive during fundraising times. And so there's a wide dispersion there. As an investor in funds, I would encourage you, as Julia said, to do your own work and really understand the kind of evaluate the underlying metrics of the companies that are in the portfolio that you're evaluating to assess whether you're going to make a commitment to those funds. Because I think at the end of the day, you should be in a position to make your own assessment of how the companies are performing with the information that is provided to you. But just going simply off of what the general partner is citing as evaluation is extremely difficult, particularly in some cases. Their policies are, we've seen general partners who mark companies up once they receive a term sheet. Others will wait until the financing round is actually closed. And so there's a lot of disparity there that can lead to misalignment on valuation.
Yeah, and I see that Ben Narrison in the chat has talked about, different people do have access to different information at different times, but the 2 decades of human behavior, seeing funds be a little more bullish on their companies as they're out raising a new fund is an interesting trend. So are we, yeah, please.
There was an interesting case, I think, last year at some point when, SoftBank Vision Fund, they publish a lot of they are public. So they published some of their marks and discussed their portfolio valuations. And at the time, kind of post WeWork, when there was a lot of questioning around that, one of the things they would say was that, they had a lot of co-investors for some of the deals that, other than WeWork, let's say, that they've done at high valuations. But at the same time, what was interesting to me was that some of those deals were marked below SoftBank Vision Fund's rounds by those co-investors on their own books. So just a case.
Yeah, and I feel like we could spend 2 hours just on SoftBank Vision. But it is interesting when you have that obligation and you are making that disclosure. And Keith, how do you see those kinds of things when you have SoftBank, for instance, putting numbers out? How does that impact secondary trades? Because that was the second category. We're not done with exits, but the second category was how to think about secondaries and founders and early investors selling their shares. How does it impact that when the mark-to-market info gets out there?
Yeah, it's a fair point. And actually, I want to come back to something that Garth said earlier, which was, as you think about valuations and you're raising capital and putting a mark on your own business, you don't oftentimes, setting the highest mark may or may not be the right strategy. And it may come back to hurt down the road. And so we've seen examples where, and we've worked on a number of transactions where the prior valuation mark from a prior financing is not necessarily in line with what the market would bear, in the current market environment. And so now you start to create a bit of a circle where if you try to maintain that existing valuation, you're in a situation where new market participants may not fund the business. If you drop the valuation to the new market clearing level, you're in a situation where you've got employee options that are underwater, you have morale issues from a down round. And, we've seen a lot of companies think about perhaps bridging that gap by using structure. Maybe the liquidation preference is no longer 1 times, maybe it's 1.5 or 2 times to get to the right valuation. Maybe there's a valuation reset. None of those things in and of themselves are wrong, but setting the wrong valuation in one financing could have implications as you think about raising capital going forward. And so we oftentimes will, see a prior financing mark, and then when you look, and the secondary trading data is not perfect, but when you can look at some of the secondary data and see where some of the trades are clearing, you may see that they're trading well below the prior round of financing. And that's something that we do try to look at whenever possible to get a feel for where do we think the market will bear a new transaction. So when you do have a particular market participant who is able to put a high valuation and put a lot of capital behind a particular company, that is great again for that moment in time. But if you're going to accept a inordinately high valuation, you need to take an inordinate amount of capital so that you don't have to go back to the markets until you've grown into that valuation. So it is a bit of a disconnect that we've seen from time to time between where the secondary markets are willing to transact and where a company may have raised capital in their prior financing round.
Yeah, And Lauren, are you seeing, Keith mentioned structure, are you seeing a move away from what we think of as clean, kind of very plain terms that keep alignment in venture deals?
It depends on the company. I think that Keith's instinct is right. I would say that for founders that are optimizing for valuation, a lot of times that comes at the price of structure. For founders that have businesses with good fundamentals, where there's where the valuation is reflective of progress being made, I think that I'm seeing very clean term sheets. And so I think that it tends to be the founders that really want to see the higher price and that matters to them that end up getting stuck with a lot of structure. So it varies. It's still, I would say in the growth rounds that I'm seeing, it's maybe 50-50.
Yeah. And we're seeing structure in companies that have a problem or a big problem or many problems. And we're seeing a lot less structure, particularly in what I would call the high velocity momentum part of the market. And there is a bit of a disconnect between the momentum part of the market and the rest of the market. And I want to talk about that a little bit. Keith, Garth, are you seeing the kind of structure that Keith was cautioning about?
We're seeing a little bit of it. I mean, I think, some of, even the valuations of the companies or the valuation of the shares when they're being sold somewhat is also dependent on the seller and their personal situation, whether or not they're distressed or they've got, certain tax issues they're trying to solve for. So it's kind of hard to get a read, in my view, on kind of how the company is doing based on the kind of valuation of that transaction. But seeing a lot more what Lauren was saying, that the higher growth momentum companies, as you mentioned, are getting cleaner term sheets. With the pandemic and kind of resetting of plans, we are starting to see term sheets kind of that have a little bit more structure on them to protect the new investor in case there is another blip or abnormality. But I always recommend to companies, founders, CEOs to avoid that at all costs. I've just been on too many board calls where you're near that exit moment and everyone should be jovial and excited, and all of a sudden that term sheet comes out and folks are saying, well, remember, I've got a 2x liquidation preference, so I'm really happy earlier investor who's not in that same cap structure is not going to benefit. And so to the extent that you can avoid it, I often encourage people to avoid it, even if it's at the detriment of a higher valuation.
Yeah, and there's one theme that really drives off of that, because we've seen for the last decade or so a tremendous success in the seed investing category. And seed investing is a fantastic strategy in a market where 90% or more of the deals are up rounds, not down rounds. And I know that a couple of you mentioned in your backgrounds shifts that were made in response to 2008, 2009, Lauren and Keith in particular. And for those of us who were doing these deals in 08 and 09, if you were a seed investor or an A-round investor and we went into a down cycle on a macro level, or the company had real problems, you would see pretty draconian terms recapitalizing that company. And the early investors would really lose the opportunity for any upside unless they had lots of fresh capital reserved for the future. And a lot of people don't reserve capital. So to the extent that you can keep clean terms, there's real value in the alignment. And that goes to issues like, we're all going to approve the same M&A exit or the same up round or the same secondary because we are aligned. And it also goes to issues of being a seed investor if we're in a protracted down market cycle, could actually be a terrible strategy, because a lot of these companies will have to relaunch or get recapitalized in a way that wipes people out. We haven't seen nearly as much of that as I expected. We're seeing a little of it, but not that much. And I know, Keith, you were written up in Euromoney about a year ago, and you said that for the last 2 years, most of the growth deals that you were involved in, you saw about a quarter of those deals had secondary. And I don't know, what people think about how common secondary is, but when we're doing $30-40 million financings and up, it feels like way more than a quarter of those deals involve secondary. In deals with 10-15 million to 40-50 million, maybe it's a quarter, but above that level, most of those deals have secondary. And it feels like part of that is a function of just how much money, massive amounts of money, these funds have raised and need to deploy. And that puts some pressure on the system. And I'd be curious to know what all of you are seeing in terms of secondary. And this is also the massive amount of money coming into funds is something that Julia wrote about this week as well. But are you folks seeing more secondary in larger scale transactions, 20-30 million and up?
Yep, and just to level set, I mean, our typical transaction probably tends to be, a couple $100 million, I'd say kind of 75 million at the lower end. And in that particular area, I think the amount of secondary has increased dramatically, particularly over the last year or so. We've done a number of transactions where they've either been 100% secondary or, north of half of the transaction will be secondary. And I think it's really a function of two items. One, you hit on, Ed, which is there's a tremendous amount of capital in the sector, and people are looking to put more money to work rather than less. And if the way for them to do so is to provide liquidity to shareholders, they're okay, because if they can write a bigger check now, they're going to have a bigger ownership stake when the company goes public, and then they're going to be able to build a real position. And so I think certainly the later stage investors are quite comfortable with secondary because it gives them a larger seat at the table and a better start at building a full position going forward. I think the other factor that's really driving a lot of what at least we've seen in our experience on the secondary piece is that the companies are just remaining private longer, right? And so they are more mature. In some cases, they're profitable. They clearly have a revenue stream from either a product or service that's being purchased by a consumer or an enterprise. And so they're real businesses that may actually not need as much capital as what companies will get, as investors want to provide to them. So if you're in a situation where maybe you need $50 million, but you have two high quality investors who can add value, they want to put in $200 million. We've seen a number of transactions where we've solved that by saying, great, we'll do a $200 million deal, 50 million will go on the balance sheet because that's really all the company needs. And, the remainder will be, we'll offer it up in a tender offer or a directed buyback. And so that's a strategy that's worked really well. So I think it's really a function of just the maturity level of these businesses, some of which are incredibly high quality businesses, and a function of how much capital is out there looking to play in the private market, because people have realized, a lot of the growth is really being created pre-IPO, not post-IPO.
Yeah,
and go ahead.
I was gonna say, so I'm certainly seeing all of what's been described. I would say the thing that has changed is that I'm starting to see secondary earlier and earlier. And so whereas before it was associated more with kind of traditional growth rounds, post product market fit, where a company was really, raising a true growth round. Now we're seeing a lot of these earlier momentum rounds that are very large in size, but where companies are still very early in their product market fit, and there we're still seeing some secondary, and it's because the rounds get so competitive and there's so much interest around the table that the investors who don't get in or don't get enough in will then approach the founders about whether a secondary option is there. And so, at these prices, founders and sometimes even early investors want to take a little bit off the table, and often do. So I think that's the notable shift. I think with the later stage secondary rounds, as Keith was saying, with companies staying private longer, it makes a lot of sense, especially the company sanction rounds, where in conjunction with a outside financing, there is a secondary component that keeps early employees and founders feeling motivated, and even sometimes early investors, because these are happening at a stage where historically the company would have been seeing a liquidity event. So those make a lot of sense to me. I think where we're potentially running into some trouble is with these earlier stage secondary rounds.
Yeah, and if we look at a specific deal, and Garth, I don't want to put you on the spot, but on September 16th, one of Julia's colleagues in the Wall Street Journal wrote about the GoExpedi deal, and I'm not asking you to confirm or deny the numbers that are disclosed in the very first sentence of the article, but it says that they raised 25 million that values the growth stage company at about 225 million, and existing backer Top Tier Capital led the Series C and now holds roughly a 20% stake in the business, said Garth TIMOLL. So sorry?
It wasn't me, I'm kidding.
Yeah, I know, it was just a rumor that you said that. The question is, when you're looking at how to de-risk and value that kind of company and that kind of round in the market, and I know that one of the survey questions was around, what does de-risking mean at the different stages, seed stage, A round? How are you thinking about that kind of deal, that kind of price? Not asking you to disclose GoExpedi's metrics, but a C round more generally, and what is that looking like in the current market?
Yeah, so it was an interesting dynamic with GoExpedi. We had actually started talking about the possibility of a growth round in early February, so pre-crisis. Obviously, the world changed, and what actually happened with that business is that they actually accelerated during the pandemic. And so we started seeing early indicators of growth through again, like I said, the pandemic that got us pretty excited. And so our decision at the board level was to fully capitalize the business now and kind of ride this wave of momentum. And so we've seen a number of our companies actually, go through, I call it the COVID dip of panic and, are we taking PPP money? Are we not? But by and large, a lot of our portfolio companies, including GoExpedi, have actually rebounded. And so for us, we thought it would be, it was really a strategic position on our part. We very relevantly or seldomly lead 2 rounds in a row, but we felt so good about the business that we wanted to kind of maintain ball control and increase our ownership while fully capitalizing the business for the next 18 to 24 months.
And so it's always helpful when you have an inside look because you presumably know a lot of the data and the difference between the predictions and the actual outcomes. How do you think about doing secondary in a deal like that? Again, not asking in that particular deal, but do the founders come to you and say, I'd love to sell? And there are obviously some strategic things around whether you want to buy out a seed fund or whether there's the desire to create some incentive for early employees.
Yeah. For us, our view is we tend to avoid kind of the secondary transactions where the founders are taking, I would say, life-changing money off the table. In the case of GoExpedi, you have 2 founders who have young kids. The current CEO is about to have twins. I don't know if he wants me to say that publicly, but they're literally due any day now. And so that was a case of getting kind of the founding team kind of more comfortable at a modest dollar amount to, again, kind of keep them kind of focused on the business. You know, in terms of secondaries in general, I share Lauren's sentiment. I do get a little bit worried that we're seeing these events happening earlier and earlier. I am seeing, you know, VCs in general kind of push back on founders, or at least making it clear that if you're going to, you know, take this option now, this is a one-time deal. So you can't come back every 2 or 3 years and ask for another secondary. And so, you know, we kind of caution folks to make sure that they're going to do something like that, to make sure that one, it's enough to keep them, get them comfortable, buy a house, get a nanny in the case of Going Speedy's case, but also not to take too much, because it does create some misalignment when the founders have taken a lot of money off and the investors are still kind of actively trying to kind of grow the business.
All right, so I want to pause on the nanny secondary for just a minute, because Rachel Lamb, who's actually speaking at our next event and ran strategic venture, the strategic venture arm of Time Warner for many years, has asked a question that's relevant to this, that goes back to Lauren. As a follow-up to Lauren's comment on earlier stage founders selling into secondary purchases before the company has truly scaled, has that ended up being a positive? Have the founders ended up staying engaged or motivated, or is that something lead investors have regretted in retrospect? Lauren?
I think it's a little bit early to tell, to be honest, because I'm seeing a lot of it happening right now. And, you know, we've seen it some in our companies, but a lot in companies that we've looked at. So I think time will tell, but I think there's concern. You know, I would agree with Garth that, like, even in those scenarios, if it enables someone to be a little more comfortable in their lives, I think that generally is motivating. But my sense is that when it's meaningful dollars before the founders have really proven what they need to prove about the viability of the business and product market fit, I think it can be a little bit distracting. And so, truthfully, I think that opining on this in 12 to 24 months will be more interesting, because I think that this is a phenomenon that I've been seeing a lot over the last 6 to 12 months.
Yeah, and from where I sit, there's a difference between taking some of the pressure off, and I have seen it in particular around the birth of a child, but taking some of the pressure off to pay off student loans or buy a first home, and enabling an investor and a founder to level set on, hey, if we get an offer to be acquired where you're going to make 1 times or 1.5 times your money, and I'm going to make $15 million or some number like that, I'm going to be able to say no, and you want me to say no. And there's a valuation range in which that is rational, because you can get there by figuring out where the investor got in and how much money the company has raised and how much the founder still owns and how many founders there are. And then there are some tax issues around that as well. We certainly see that discussion happen right after the 5-year mark, where the founders have good qualified small business stock and have a real tax benefit, especially if they're outside of California. And being able to de-risk and knowing that a founder is going to be able to say no to a lower range M&A offer does seem to us to have some value. Doing it before product market fit is a little more dicey if it's a meaningful number, as opposed to a let me just take the pressure off, especially because the founder hasn't been paid a market wage for a while, kind of number. That's from where I sit. And I also wanted to use the response to Keith's comment about public markets as a bridge to get into the Chime story. And I want to give a little bit of data. And I'm now going to talk out of school a little bit, but I will credit the folks at GGV who have done a lot of analysis and writing on keeping companies, on holding stock after IPO, and on staying very late. And they, I had a conversation with them recently where they looked at a whole bunch of venture-backed companies that had gone public, and at the run-up post-IPO, so companies like Square, $2.9 billion IPO in 2015, valuation now $69 billion, or Etsy, $1.8 billion valuation at IPO in 2015, now $13.5 billion, or Wix, $750 million valuation at IPO in 2013, now $14.2 billion, and Just Eat, $2.4 billion at IPO in 2014, now $16 billion. And so that makes the case for a continued run up. Now, obviously we've had a bull market for a really long time. I don't pretend to understand why, I just know that we have. And there are definitely sector wins in those narrow spaces, but because we mentioned one of those companies now being valued at 14 billion, that's a good segue to Chime. So Lauren, Chime comes to you to raise an early-ish round, and they were pivoting the business. Am I getting that right? And you're at the time you're a principal at Fund One of Aspect, right?
Yeah, that's right. Yeah. So the founders had been working in and around the space for a long time and had a view that there was an opportunity to use technology to serve a underbanked population with a technology-driven suite of financial services. But so that was always sort of the vision. But they actually started with a secured card that was oriented around retail purchases with rewards. At the time, I think it was a bit easier to get to market. And, I think that there was a sense that consumers may have wanted, those that didn't have traditional credit cards may have wanted some of the associated perks and credit building opportunities with credit cards. And so they started there. And I think that what they saw was that actually the people they were trying to serve just wanted a more kind of foundational product, which was a checking and savings account and debit card that was tailored to their needs. And I think the interesting thing is that at that time, a lot of people were skeptical of the fact that any meaningful share of wallet would switch over to debit transactions. But when you look at the population that ended up adopting Chime, they were very tentative on adopting credit cards. They were afraid of credit as a result of the recession. And so very quickly, this became primary bank for many Americans. And so yeah, we led what was kind of the Series A associated with this new business model just after the pivot, when they were just starting to see some adoption of the new product. And so effectively it was a Series A1. They sort of went to market and re-raised a new Series A because they had made this pivot and had such strong conviction in the opportunity with a bank-like product.
All right, so you lead the A1/A in 2016, right?
Yep.
And
yep.
And you're a principal at a first-time fund. Obviously, the fund had credibility, and you mentioned your friend and partner Teresa. She's been on the Midas list 9 times. She's kind of a legend in venture. You win the deal because it's a super hotly contested deal, and you bought the founder a car. How do you win the deal? Which is not a knock on you or Aspect or Teresa. And for disclosure, I'm an investor in the fund, so obviously I'm a believer.
So there are a couple things. So it's hard to imagine now, but then in 2016, challenger banking was not a hot space at all. I think that there had been a couple examples of companies that had moderate success. And I think that the market was largely skeptical of, interchange as a driver of business model, and didn't believe that the unit economics could work. And I had been doing a lot of thesis work around this area and really saw the opportunity for a branchless digital first bank And I, as a principal that had to work really hard to find deals at a new fund that were going to be a mutual fit, I was willing to do the extra work to really dig in and understand the unit economics over time. And so I saw a massive opportunity here. I think that the other thing that made this unique for us is that, the founders were not looking to, they were conscious of dilution, and they wanted to raise enough money to kind of get them to the next phase. And so, they weren't trying to sell 30% of the company at the time. And we were a little more flexible in our check size, and had a little less stringent ownership requirements. And so, we kind of slotted in at a moment that made a lot of sense, and where, frankly, the rest of the market was, I think, a little less excited about the opportunity.
And part of why we're talking about this today is it was announced a couple of weeks ago that Chime just did a deal that values the company at how much, Lauren?
$14.5 billion.
$14.5 billion. Okay, so when you led the A round 4 years ago and took the board seat, Chime was valued at $2 billion, $3 billion? No, you don't have to disclose, but it was a pretty low number.
It looks more like today's seed rounds, I would say, given how seed rounds are going. So yeah, it was much lower. And you doubled down in the B round and the C round as well. Were those much more competitive rounds? Like, at what point did you realize, holy crap, this company is hit escape velocity? I mean, truthfully, I think I realized that shortly after investing, because they just, every number they projected, they hit or exceeded, and really on the most kind of fundamental level. I mean, gross margin expansion just kept going in the right direction very quickly, and their ability, the team's execution on marketing and efficient marketing, led by Melissa Alvarado, who's, I think, one of the best marketers I've ever seen. Was
she's now going to get poached, right? Like, you just did that. She's going to get poached. What are you doing?
She's incented to stay, but she's. I mean, talk about, and you should have Melissa on one of these things. I mean, talk about someone who is so under the radar and just completely exceptional Latinx woman. Amazing, just amazing human being and exceptional marketer. So anyway, so she just grew the thing like a weed, and so I think I had a sense for the fact that this was something special pretty early on, but it took a couple rounds for, I think, the mainstream VC market to catch on.
Okay, Garth, Top Tier is a terrific LP in lots of venture funds. How often does Top Tier invest in a fund one from a team that maybe has people who have a track record, but it's a fund one and they haven't worked together? It's not a spin out from another firm.
We do it on occasion. We look at a lot. We look at more than we invest in, but we actually have a dedicated pool of capital for this activity, kind of finding newer, kind of up and coming managers. I would say that the things that we're looking for are, some resemblance of track record, kind of state the obvious, to the extent that the team has worked together. I think is very important. Having looked at thousands of funds over my career, I willing to go on record in saying that what ends up killing kind of fund two and fund three is not the track record. It's the team sticking together. And so for us, it's really spending a lot of time evaluating the partners that are coming together, evaluating their strategy. Is it unique? Is it differentiated? But really kind of diving deep on kind of the gel and the motivation of why, 2, 3, 4 individuals are coming together to launch a new platform. And
you're in the industry, there's a tremendous amount that has been written and repeated 1 million times about one difference between venture and almost every other asset class. In venture, success is highly concentrated and highly persistent, meaning that a small number of funds just repeatedly win over and over again. And that creates a great excuse for LPs to not fund new managers. And in the case of Chime, if it's now valued at 14.5 billion and you have a manager that led the Series A round only 4 years ago, what entry point valuation would Aspect, forget about what they actually paid, but at what entry point valuation on that A round would that have been a good bet for one of the VCs that you back? Like at $1 billion, that's still if Lauren had done the deal at $1 billion valuation, that's still a good bet for you, right?
Yeah, so I mean, it sounds that way. I mean, hindsight is 20/20, but I think Lauren said something really important around kind of she identified the kind of the metrics of the business, and also having the talent at the exec level to bring the company forward and grow. That's usually the hardest thing, right? Is not only finding product market fit, but having a team that can actually help a company kind of achieve their maximum value.
So the reason that this is so fascinating to me, and by the way, congratulations, Lauren and Acrew. If you look at that round, and this is something that Shai Goldman of SVB shared on Twitter, and then I did a little thing which I put in the chat earlier on it. But if you look at that round, it's Aspect Fund 1, it's Homebrew Fund 1, and it's Forerunner Fund 1, and there aren't established Fund 7 in there. And I mentioned this because we're seeing other examples of this where success is more democratized in venture. And I'm wondering, Yulia, you've been writing about the duality in fundraising by venture funds, and that's also something that people in the survey said that they wanted to hear. Fund 1s and Fund 2s are having a harder time raising money from LPs right now. Are you still hearing a lot about how people perceive if you can't get into the top 10 funds in venture, kind of don't bother, and therefore success persists in that small cluster of top funds?
I think it's gotten much harder for first-time fund managers to raise. That's definitely true. We just see that in the actual numbers of new funds being launched. They're down and they've been on decline. I think since 2018. 2018 and 2017 was the biggest year recently for new funds. And part of the reason is maybe not even that LPs are not interested in new funds, but that they have a limited capacity and existing funds are raising bigger funds faster. And so there's certainly, most LPs would want to continue funding the firms they like, and they're not gonna cut back to include a new manager necessarily. So I think that's one of the part of the dynamic that's happening right now. And it is a recession right now. It is. I think people are just a little less risk averse potentially, so they'd rather invest in what they know rather than a new firm. And there are, of course, risks with a new firm, even around the team and how well they gel. And I mean, Aspect broke up, and we had a bunch of other examples of firms that broke up, and many of them were relatively new firms. So that's another risk that LPs take on a new fund.
Yeah, and how do you think of the risk when you have a fund that's created significant wealth? And maybe this is a question for all of you. How do you think of the risk when a fund has created massive wealth and then a partner, takes a sabbatical, or a partner leaves and does his or her own family office, or multiple partners leave within 2 years or so of that kind of significant wealth creation? Because that's also something we've seen in some of those funds that are Roman numeral 10 or 7. And when you have a situation where 3 partners kind of call it rich and leave, it's not like they were working super hard up until the very day that their departure was announced, right? They were probably thinking about other things, and they were also, from an integrity perspective, they're probably thinking, I'm not sure I want to take a new board seat a month before I'm thinking about leaving and doing my own thing. How does that risk factor in on some of those more established firms?
I mean, we definitely saw examples where people left and were able to raise pretty quickly. And you know, those who have the track record, the individual track record, have been overall pretty successful. I feel, I don't know if I have the stats. I definitely know of examples. It's harder to know the stats, how many tried, right, and didn't raise.
Yeah, but also the funds they left still seem to raise, even though there are newer partners in the ranks, and you don't know if the person with the magic has now departed or the people with the magic have now departed. Garth, I don't know how you look at that, or Keith, if you have thoughts on the fundraising from the VC side.
Yeah, you know, I think back at when I first got into kind of fund investing, you know, a long time ago. I looked at that list of top 10 firms that you're kind of describing, and what that list looks like today. It is very different. You know, what I often suggest to new folks who are investing in the asset class for the first time, or now have quote unquote access to those high Roman numeral funds. If you now have access where you didn't have access, it's likely because the institutions like a top tier who've been tracking these funds for a long time are no longer supporting them. And so to be cautious with that, I think it's really hard. I think venture capital as an asset class is, really it's the transitioning of generational leadership is difficult, and we've only seen a handful of firms do it successfully. I do think there is some brand amongst or brand recognition amongst entrepreneurs wanting to work with certain well-known brands, but by and large, I'd say 90% of the time it's partner specific. And so when those partners leave, it usually is a sign, and not necessarily a good sign that things returns will continue.
Yeah.
I think what's interesting is that there are a lot of new funds being set up, though, that have, where people have lived that reality of the pain of generational transition, and they're actually being set up in a way that is intended to combat that structurally and with the people around the table. And so I think, that's another reason to be looking at some of these emerging managers. It's certainly something that we have tried to do at Acrew. Yes, Yulia, we did obviously split up, but for the most part, it's 5 to 7 full-time people, and from Aspect, they're at Acrew, and we're all still managing our portfolio. So but I think that when in this incarnation of Acrew, the philosophy behind why we started it in this way is that we want to build a firm with like-minded people that are philosophically oriented around building a firm that outlives us all. And so to do that, like, one of the things that is pretty critical to sort of our strategy is we have 3 generations on the founding team itself. A lot of firms are started by age peers and they bring on new generations over time, but there's a lot of hierarchy there. And for us, we have 3 generations on the founding team. And I see other firms doing the same thing. Renegade Capital is another example, run by Roseanne Winchek and Renata Contini, and they have a similar philosophy, and there are a number of others. So I do think it's worth highlighting that that there's a reaction to the fact that generational transition has been so problematic, and you're seeing it in emerging funds.
Yeah, and there's a comment in the chat from my partner, my new partner, Rossi Terman, which is, isn't this a commentary on valuation or inflation of legacy over performance? Performance is a lagging indicator. And even if, there's this great fallacy about like brand enables you to win the best deals, not clear which deals are the best deals until much later in the day. And lots of venture investors have to make those bets that a company is still financeable, or that a company that lots of other people passed on, like Chime, is going to be a great, is going to be a great company. So just, something to think about how we prioritize brand when it may be individuals are pretty valuable components of that.
And
of that calculus.
I just wanted to add something on the secondary discussion that we had.
Yeah.
Somebody
Please.
asked about regrets, and I know that I've definitely spoken with LPs who are not happy about some outcomes where the VC lost money, the LP lost money, and the CEOs did very well. Or the founders did very well. So there are, and we have WeWork, right, as the existing case ongoing, I think. But at the same time, as somebody else mentioned, you never know, right? And so with Chime in particular, I wrote about one of their prior rounds, I think a 1.5 billion round valuation, where one of the early VCs sold their entire stake. They probably didn't expect it to go to 14.5. And they did well, right? They did well and their LPs were happy, but they would have been much happier if they sold it in this round. So,
yeah.
I know what you're gonna regret.
Yeah, although people do that often as they're in a fundraise or about to enter a fundraise, because if they have the ability to return the entire fund or return, a big piece of the fund just before a fundraise, that is a terrific way to raise raise a fund with the wind at your back. Here's a check. Would you like to return it to me for the next fund? So, and there's also, an element of portfolio construction. So, when we're thinking about the liquidity and secondaries and fundraising, Julia, you wrote this piece about people trying to raise venture funds before the election. The election is now very close. Keith, where are we in what happens if we don't know the outcome of this election? What happens to the market for venture-backed companies?
Yeah, it's a good question. I wish we had perfect insight. I think the public markets are, quite comfortable with whoever ultimately wins. I think the biggest thing that people are concerned about is really what happens if we don't have a winner for an extended period of time. And I think that's a really hard thing to price in from a volatility standpoint. So we have a number of clients who are trying to see if they can get their capital raised over the course of the next month or so. And, those who have the wherewithal to wait are really taking the approach of, maybe I'll start up again in January. So I think you're going to see a big window of capital and a number of deals get announced over the next, month, give or take. And then you'll see, a bit of a lull as people see kind of what plays out over the course of what hopefully will be a day, but easily could be, a month or more. So I think that's the big piece that people are focused on. I don't know how that translates into actual venture funding as it relates to raising GPLP funds. My suspicion is that really shouldn't matter, because if you're coming into a new fund now, that fund is going to have, 5 years to put the money to work. So I don't think you necessarily need to think about timing the market, per se. But for individual companies that are raising capital, rightly or wrongly, we have seen a push to try to get things done over the course of the next month or so.
Are you folks slowing your roll?
No, we have deals that again, our bias is good companies will always get funded. And if we have a little bit of dislocation, for a few weeks or a month, I think, good companies can certainly, withstand, periods of volatility. So we are in the market actively with a number of capital raises. We have a couple that'll get started in the next week or so, which clearly won't be done by the time of the election. And, our our view is, if we pick the right companies and tell the right story, those companies should be able to get financed. So we're a little bit less, concerned, but clearly trying to keep a watchful eye on the markets, because what happens in the public markets certainly, impacts what's going to happen in the private markets, although the private market tends to be a lagging indicator.
Garth, Lauren, are you folks seeing people slow their checkbooks just a little bit in the current market? Just like might as well wait and see what happens in early November?
Honestly, no, we haven't. We're still pretty active on the fund-to-fund side of the house with groups coming back to market that should be closing this quarter or coming weeks, and so it hasn't really impacted much of that world from our vantage point.
Lauren, deal flow?
It hasn't had much of an impact for us. I think at the early stage, it's just so far from the public markets, and I think that so I don't think it's really changed anything at the early stage. I do think it impacts as companies gear up for IPOs, sort of waiting and seeing to see kind of what the window looks like, especially in the case that we have a contested election. I am sure that for a little while there, people will be watching, but I think at the early stage, it's not really impacting us.
Yeah, and anyone want to take a view on the impact of the most recent direct listings and the fact that we have these SPACs and that there are now, a bunch of other ways to become a public company? So the issue of whether the IPO window remains open, is that still as big an issue if there are other ways to become a public company?
I mean, my personal view is it's still, the IPO market is still a powerful, capital raising tool. And I think it's still an important part. You still need buyers there, whether you go public via SPAC, which oftentimes will have to do a pipe financing to bring in, public style shareholders, whether you go public in a direct listing, which, can certainly be bid up on the back of retail, but the sustainable valuation is going to be on the back of institutional investors, or you have an IPO market where you're placing a majority of capital with institutions. I think it's three different ways of getting to the same buyer base. And so I think at the end of the day, my view is, all three, certainly have a place in the market. I don't think the IPO market is perfect, but I also don't think it's going to go away anytime soon. And I think, SPACs, certainly are going to have a place, maybe not as prevalent as they are, today, where, you can raise a SPAC pretty comfortably. And direct listings, I think, people want to see, today, yesterday's debuts were, I think went about as smoothly as could have been expected. So we'll see where those continue to shake out. But at the end of the day, you're accessing capital from the same pool of investors. It's just a slightly different form.
I want to commend you on not dinging your competitor for their software failure in yesterday's direct listing. I think you went high there. So that's good. Julia, do you have a view on where we're headed with the markets? And, you talked about people wanting to rush out before the election.
That's in terms of venture funds and public listings. I think that's definitely happening for funds that, for example, for funds that have a good track record, they'd rather get it done. I mean, that would always be the case. You would always want to raise more faster rather than less later, right? Yeah. But I understand that like October 1st, and October 15th were some of the closing dates that people had planned for their funds. And I heard the same thing about like kind of a probably, and then a lull, and then targeting funds being targeted for early next year closings.
Yeah, so we are, and I'll just wrap up now because I know that we're timed out, and if people want to send us questions after, happy to try and get them answered for you, and want to thank all of you for being here. we are still seeing momentum, and we're not seeing people talk about, hey, let's pause around the election, or how do we get this closed before the election because we're de-risking. And, you know, had a kickoff call yesterday on a multi-billion-dollar valuation transaction. And it's like, how do we get this on the investor side? How do we get this closed in 2 weeks? Which is a tall order. And we're continuing to see term sheets land. So we'll see if people hit pause if the election lands sideways. I think that will be a problem for the financial markets, and it will ripple. And to Lauren's point, we'll see if that goes to down all the way down to early stage. But I want to thank Lauren, Keith, Garth, Julia, and Regina for the wonderful report on Black Women Talk Tech, which we'll email to all of you. Really appreciate all of the insights. Also really appreciate the valuable nonprofit work that you folks are doing on the side of your day jobs, and thank you for that, and thank you for talking about that work, and look forward to finding more deals to do with all of you, and to seeing everyone on November 12th for Dick Parsons and Rachel Lamb and my colleague Diane Moss. And thanks everyone for joining us for VentureCrush.